Hi everybody, my name is Muhammad Amshar bin Zaid and I'm from JBA 1144D. Today we are going to talk about choosing between margin trading, short selling and long purchase. So before we continue with the video, I hope you guys can hit the like button for me to get some extra marks. Thank you very much. So as you guys can see, there are three basic types of securities transaction that we are currently learning. The first one is margin trading, the second one is short selling, and the third one is long purchase. We are going to start this off with margin trading. So what is margin trading? Margin trading is the money borrowed from a brokerage firm to purchase an investment. It is the difference between the total value of securities held in an investor's account and the loan amount from the broker. Buying on margin is the act of borrowing money to buy securities. The practice includes buying an asset where the buyer pays only a percentage of the asset's value and borrows the rest from the bank or broker. The broker acts as a lender and the securities in the investor's account act as collateral. As you guys can see here, there are three advantages of margin trading. The first one is increase of our buying power. This is the most obvious advantage of margin. To be able to control a much larger position by borrowing from your broker than you could by just using your existing equity. The second one is flexibility. Trading with margin not only gives you the advantage of taking larger than usual positions, but it also gives you flexibility to build a portfolio. Let's say you have a small account and because of it, you can only take one position at a time. With the introduction of margin, you are going to be able to use your equity to open more than one trade simultaneously, thus giving you the opportunity to diversify your trading in various instruments daily. The last one is exponential account growth. Before margin existed, it was very difficult for small retail traders to grow his or her account rapidly because they could only take positions as big as their account balance. Managing that position and day trading various instruments became difficult, if not impossible, for the small trader. Trading with margin gives you the opportunity to take on various markets at the same time during the day, thus profiting from more trades and exponentially growing your account to a more manageable size. Next, we have disadvantages of margin trading. The first one is increased risk. This is the most obvious disadvantage of trading with margin. To be able to control a much larger position than usual means not only that the profits can be bigger, but also your losses can also be big. This is why you must be careful and stick to a very strict risk exposure and money management rules when using margin. Second one is stress. Some traders can't handle the stress of having too large of a position open because of the fluctuation in their unrealized profit or losses is too big, and this makes them take irrational decisions. Letting your emotions get in the middle of your trading decisions will make you lose money in the long term. If you can't handle big fluctuations on your P&L, then you should start with smaller position sizes. The last one is margin calls. This is what you must avoid at all times. To get a margin call from your broker means that your equity is so low that it can't support the minimum margin requirements from your broker, and your trade will be closed with a loss, leaving you with a very small percentage of your initial equity. To understand what a margin call is, you must realize that this only happens with terrible money management, and you should never risk that much on a single trade. The second type of security transaction is short selling. So what is short selling? Short selling is an investment or trading strategy that speculates on the decline in a stock or other securities price. It is an advanced strategy that should only be undertaken by experienced traders and investors. In short selling, a position is opened by borrowing shares of a stock or other asset that the investor believes will decrease in value by a set future date, the expiration date. The investor then sells these borrowed shares to buyers willing to pay the market price. Before the borrowed shares must be returned, the trader is betting that the price will continue to decline and they can purchase them at a lower cost. The risk of loss on a short sale is theoretically unlimited, since the price of any asset can climb to infinity. The most obvious advantage to short selling a stock is being able to make money not only when a stock goes up, but also when it goes down. Another advantage is that you can hedge your portfolio. If another bubble pops or another financial crisis hits, there is a good chance your portfolio is going to face a setback. Even if you're not an indexer and have invested in some really sound companies, if that happens, having shorts in your portfolio could provide gains that offset your losses. There are two disadvantages of a short selling. The first one is commission costs for short selling stocks. Most brokers offer the ability to short. The no-cost online brokerage does not offer clients the ability to short stocks. Typically, the same commission applies for short sales as for long positions. The fact that you're selling first and buying last doesn't make any difference to most brokers. Commissions are just a cost of doing business, though, and frankly, if commissions are killing you, then you have the wrong broker and you shouldn't be investing anyhow. The second one is margin interest. So, shorting a stock will place a hurdle of 7% to 10.5% every year in your way. This means that you may have to earn at least a 10.5 annualized return on your short sale just to break even. If you go with a broker that charges margin interest, you had better be sure that you are right. Lastly, we are going to talk about long purchase. So what is long purchase? Long purchase is a situation in which a dealer in a particular financial is selling less than he buying. As an example, you have the right to collect the dividends or interest the security pays, the right to sell it or give it away when you wish, and the right to keep any profits if you do sell. Similarly, you have a long position in an option when you hold the option, and you have the right to exercise it before expiration or sell it. There are two advantages of long purchase. The first one is great for taxes. As you guys know, buy and hold is great for long-term capital gains. Any investment that is held and sold for a period greater than a year is eligible to be taxed at a more favorable long-term rate as opposed to a higher short-term rate. The second one is the possibility for exponential gains is high. Quite simply, it has been proven time and time again to return exponential gains on invested capital. A list of the top buy and hold practitioners is a veritable who's of the greatest investors of all time. Perhaps some of these names might ring a bell, such as Warren Buffett, Jack Bogle, and John Templeton. However, long purchases do have their own disadvantages. The first one is ties up capital. The biggest drawback of this strategy is the large opportunity cost attached to it. To buy and hold something means you are tied up in that asset for a long haul. Thus, a buy and holder must have the self-discipline to not chase after other investment opportunities during this holding period. This is exceptionally difficult to put into practice, especially if you have picked up a lagging stock. The second one is market crashes. Just because a stock or an index fund has been held for many years does not mean that it is infallible. While nothing short of the apocalypse will kill off the markets of developed economies completely, crashes do occur from time to time. In the event of a correction, leading to a prolonged bear market, buy and hold portfolios can lose most of it, if not all their gains. Lastly, out of these three security transactions, I have decided to choose short selling. This is because short selling have the possibility of high profits. Also, there are little initial capital required, leverage investments possible, and also hedge against other holdings. For me, short selling is the best option here. How about you guys? If you want to let me know, go into the comment section and write below. Thank you so much for your time here and enjoy your day. Until we see you again, goodbye.